Good morning. Welcome to the workshop. Today, we're going to dive into a little viewer mail, sort of through Reddit. So it's sort of viewer mail, but not really. Anyway, we're going to answer a few questions about the markets and about trading, among a couple other things that are going on this summer out there in the wild, wild west. So we're going to get to all this after the bell. Interestingly, did you see? I heard that Dutton Ranch, the spinoff from Yellowstone, is actually really good. I was out to dinner last night, and they said that this group said that they're watching it. And it's excellent. It's better than Yellowstone. Isn't that exciting?
No, because I would have to watch Yellowstone.
Oh,
yeah, I'm with Jason.
One of the best bunch of characters out there, man. Awesome. All right. Well, whatever. You guys are city folks. That's why. I'm a big country guy.
Yeah, that's it. I'm a city folk.
Yeah, you are a city folk. So what's going on, guys? Earnings today, Tesla. I'm fighting. I got to be honest. I did my Tesla play. It was good pre-market, and it's decided to go not as good once we got open. So
let me get the double diagonal.
I'm in fighting mode right now. So I'm boxing it out. We're going to see how we end up. So I'm not giving up yet. Anyway, so Mark, you said earlier that there's some questions. Was it Reddit? Did I get that right, or was it elsewhere? Discord?
Yeah, someone reached out to me, and I thought these were actually some pretty good, interesting questions. A little bit about market making, but a little bit about some pricing model stuff. So I thought they'd be good to take here.
Let's do it.
Okay, I'm going to paraphrase a little bit here.
Sure.
But the first question was, from what I understand, pricing models used by traders are pretty well known. If these are the models that they're using to quote the bid ask and everyone's using them, what does a quant researcher do? What does someone that's like, why are people still studying pricing models? And what is that about? I have an answer. I'm curious at Jason's answer too, actually.
So what do quants do?
What is the purpose of researching pricing models or ongoing research in pricing models if most of the ones are pretty well known and established?
Well, I mean, overall, I think a lot of the quant. So from what people tell me, a lot of what the quants are doing is either refining cost models, looking at, there's a lot of costs. Option pricing theory out there, and they're looking at different ways that the plane can be priced more accurately. I did run into in a prominent hedge fund somebody who is doing something similar to what Volland is doing, and it turned out to be like a sharing kind of thing. They're looking for different data sets to improve their models, and it's constantly like trying to nail Jello to a wall. They're also trying to figure out models on what the other market makers are doing. And those are kind of like the people that I'm talking to on the market making side. But I would love to hear what you guys have to say though too.
So let me chime in here. The end of the question, Mark, is what does a quant have to do anymore? Or is that kind of the gist of it here?
Mm-hmm. Sure.
Okay. So I think relative to pricing options, there's probably not much more to do, right? Because I think all these big market maker shops have honed this down to a pretty good science. And if you're going to price something, I mean, what are you going to discover that's going to make that very much different? It's going to be a penny here, a penny there. Not exciting, I don't think. I think where the quant world goes now is, maybe taking that model, but also taking relationships across products and across implied volatilities, and when things are relatively cheap and relatively expensive, and taking advantage of a dispersion book for a retail person. I use that in quotes, because that's a tough practice. But maybe there's, with AI now and all that's out there, you can compile something that says in an industry group, XYZ stock hasn't performed well, and the implied volatility and the tails are cheap. So relative to that industry group, I might want to buy this stock, and I'm going to use calls to do it because of where those critotic tails exist, right? And they're really cheap relative to the marketplace, and I'm going to load up on them. So I think that kind of analysis could be interesting. I don't know. That's my thought. Marky, what do you got?
Yep. No, I agree with that. And I think relationships is a big one. I think, there are always funky things like dividends, corporate actions. Like, I think in some ways, like, it's getting better at some of those esoteric situations that you have to price. And the other point I would make too is speed, improving the speed of them.
Yep.
That, you want to have like a very good model, but also a very fast model.
Yep.
And, especially with so many different series out there, being able to reprice very quickly across an entire spectrum is, only going to continue to be a demand.
Got it. That's good. I like it.
Yeah. I also think relationships is a big one too. Like the what you guys were saying about, because like now SpaceX comes out. How do you quote that? So there's like new issuances, relationships, but also pricing is a moving target too. So I mean, it's kind of I've run across quite a few that have they end up we're trying to pick each other's brains kind of thing.
The other thing that I just thought of too is I kind of like unusual option activity with a asterisk, right? I'm not always sure what it means. If something's oversized relative to normal volume, average daily volume, I think there's got to be a lot of sleuthing to figure out what actually the trade is. So especially, I want to know when Goldman, JP Morgan, all the big banks are rushing into a name and they're bullish or bearish. And it doesn't mean because they're buying calls necessarily that they're bullish. It could be the opposite because they're making it synthetic. We don't know. So if there is a lens into that sort of activity, that to me is helpful. I'm never going to put myself in front of billion-dollar firms who have researchers who just are good at picking direction, and ultimately, I want to join the crowd. I want to jump on with them, but I got to understand.
I do have kind of a vested interest in that because we are providing data to a new unusual options kind of thing. It's more like a time and sales than it is unusual options, because I find that somebody has to determine what the threshold is for unusual options. And that's kind of, that throws a whole monkey wrench into the whole thing. Right. Sure. But we do, Samantha LeDuc is coming out with something called Option Teller, which, gives you like the full list, with like some assumptions and premium, like, it gives you the total premium that was purchased, some assumptions, like, basically using delta and a couple other things. Is it bullish? Is it bearish? Is it hedging? Is it not? Stuff like that. So it's a pretty cool tool.
That's good.
But I always, the thing that always got me with options, unusual option activity that's out there is they cherry pick, and then when they throw their ads up, they're like, oh, look at this big trade that happened,
right?
That predicted this merger. And then you're like, well, yeah, but there was this other big trade that wasn't.
Yeah. That's why I think it's a little bit imperfect. So, Okay.
All right, I got number 2. That's good, and maybe it's a little bit of kind of what you guys are talking about here. Yep. So there are obviously, in addition to market making strategies, there are market taking strategies. Forecasting what volatility is, what some of these relationships are, vols cheap after earnings, whatever this taker side, edge would be. Mm-hmm. If market makers are just there to take advantage of the bid ask, and these other strategies are, objectively true and positive edge or whatnot, why aren't these inefficiencies part of their pricing models? Or how does a market maker take advantage of some of the, potentially legitimate edges that exist on the taker side?
I don't know the answer to this one, because I don't think there's edge on the taker side, except for the fact that you can choose when you want to be in. Well, I take that back. There is some edge. but it's not necessarily a pricing inefficiency edge. So you're not going to do a conversion or a reversal in today's marketplace as a retail person. You can't buy the bid and sell the offer, and anything south of that is giving up all the edge in these things, right? So there are edges that you can pick and choose when you want to be in a trade, right? And you don't have to be on every trade, and your timing is probably one of the better edges. And if you have a system of discipline where you get in and out of things, your exit strategy is very good and you stick to it, that can be edgeful too. I don't know. I'm not sure. I think, notice.
Okay, well, I mostly agree with you.
Yep.
I think another asterisk might be that like retail can sometimes take more or different risk. That can be an edge that they can do.
Yep.
Do you believe that you think vol is cheap or expensive at sometimes then?
I do believe it's cheap or expensive relative to a historical plane. What you do with it necessarily, I'm not sure, because when volatility is high, it doesn't automatically mean you just sell it, because you have to buy something in terms of being, hedged. So you have to pick and choose the best possible things to sell in high volatility versus the best possible things to buy in low volatility. And that could be a whole plane of strike selection too. That could be certainly a good edge for you as well. So
I think that's really well said. And that, like, I think that kind of is the answer there. Like, it's you manually adjusting and seeing those opportunities. Like, is there an absolute, like, incorporation of that idea that, vol is generally cheap, it's generally expensive, I'd rather be a buyer than a seller? Like, it's more manually tilting things rather than explicitly incorporating that as a strategy, say.
Right. Yeah, and think about the retail person.
Slower to sell on one side, faster to buy, whatever it might be.
Yeah, and you may have the personality where you like selling premium more, or vice versa, you like buying it more. Well, what does this premium seller do in low volatility environments? Does he just keep selling it? I think there's certain strategies where you can actually be collecting theta, but being long vol, right? It's a calendar, it's a diagonal, those kind of things where if you have this love of selling premium and collecting theta, that's one way to do it in low volatility environments. It's not the greatest thing in the world, but it's a way to kind of stay in the game, right? So
yeah. So all right. So all those questions, like if there's all this edge on the liquidity taking side, or is there edge on the liquidity taking side versus the liquidity buying side? I agree with Lex that adverse selection is the taker's edge, right? They go in and come out how they see fit. I think you have to define edge, because the dealer's edge is mechanical and the taker edge is speculative. Even if you have like the greatest technical setup in the world, it's speculative, right? I think that you can say that vol is cheap or expensive because it's never perfectly priced. Like there's, if you do a 30-day historical volatility compared to what IV was back then, like sometimes it'll be close, but they never like match exactly, right? So you could say that looking back, that IV was cheap or expensive, right?
Mm-hmm.
But determining that going forward from this thing is really what like platforms like mine and stuff like that are all about. Like what made vol cheap then and expensive then, and like looking back at how vol was priced and then the reaction function to what that vol was when going forward, when that you could almost say like realized implied vol kind of thing, like where what happened there, right?
Yep.
And that is kind of really, if you're trading vol, that's what you're trying to figure out, is what happened there. Like why was it priced lower than the result?
Mm-hmm.
And there's all these like, metrics and stuff like that. And can you call that edge? Not really, because that's, it's speculative. You're trying to predict something, but the dealer's edge is concrete. It is bid, ask. I get these little things and get paid to manage the risk.
Mm-hmm. Right. Yep. What do Mark? You were saying, Mark, too. you already said, I think, on this one, right?
Yep. I think the last question is also a good one.
Okay.
And it kind of goes, both moats for market making and moats in general and trading, right? For options market making, a lot of the edge is passively, collecting, what Jason's calling structural edge. Like with access to markets, the ability for anyone to code up anything, like seems like that barrier to entry is getting lower. Like what are and that goes for market making as well as really any kind of professional trading. Like what are those barrier to entries, and like what does that mean for the markets?
I'm not sure I understand the question. In barrier to entry, are you talking about for a retail person barrier to entry or a market maker? Sorry.
Maybe the fact that these barrier to entries are getting significantly lower. What does that mean for markets?
Yeah. Okay. So
To me,
think about where this option market was. I'm going to say 10 years ago, pre-COVID. Okay. And even discount broker, even pre-Robinhood, right? You paid $1 a contract to get in and out of here. Markets were wide. There's no real, super incentive for a retail person to be active in the marketplace, right? And option volume reflected that. Then all of a sudden, Robinhood comes into the scene. I'm not necessarily saying they were the cause of all this, but they were a big help. And they start offering free trading. Well, all of a sudden, that starts to democratize access for the retail person. Now, all of a sudden, you need a good computer. They give you a platform, and the markets start looking a little tighter. And as we know now, time went on, and other entrants came to the market. We came in the market, Webull, all these other players, Tasty. And now you have everyone competing for that same order. Well, look what option volume's done as a result. A, markets have gotten super tight, and B, they've become super liquid, and C, it's so cheap for a retail trader to open up his computer and trade, right, with free commissions. So it's insanely easy to get in. There's virtually no barrier to entry to get into the market. The barrier to entry that I always find with retail folks is, why in the world would I ever make a trade? What's my reason? And I struggle with myself. I mean, I've got good ideas in earnings plays, because it's non-directional. I don't care which direction it goes. And for me, and Mark, I don't know how you are from the market making days, but I have no training in understanding direction. Zero. I don't know if a stock's going up, going sideways, or going down. I can't read a chart. I know what they mean. I think it's baloney. I don't believe it. But people swear by it. And if you can be successful, great. I need an idea generator. And if AI is going to help me get there, that's where I think it becomes, even more democratized. And can everyone win? Yeah, I'm not sure how zero sum it becomes if my strategy is to be short and I'm right at it a lot. Well, the market maker's still going to make money, even if he's got the other side, right? So I'm not sure. I think option volume is it could potentially double daily option volume with the whole AI craze and the access to this marketplace. I really do.
Okay, what was the question again? Because I thought I had an answer to the question, and then Lex, I think, answered it differently than I was thinking. So
yeah, that's all right. Go ahead, Mark. Just kind of paraphrase the question one more time.
Broadly, low barrier to entry in markets for all different types of participants. What does this mean?
Increased liquidity. That's what I was going to say.
Yeah, well, that's true. We've noticed that, right?
Yeah.
And Mark, you wrote a great piece on this a while back when we were dealing with PDT, and it has to do with those little cuts of information that every retail person gives to a market making community. Every one of those trades, 1 lots, 2 lots, 3 lots, is helpful for defining the market price. It gives the market making community information, and those people are vital to their community because it's an ongoing revenue stream for the market making community, right? So they can keep providing liquidity because it keeps the lights on for them. And I think that's really important. It's symbiotic. The retail community and the market making community, they live together and they can both do well. They really both can do well in that world, right?
Yeah, more liquidity is better for everyone, right? Like the more information that comes to the market just allows everything to get, better and better priced. And that's, good for the entire stack of participants.
Yep. I agree.
Yeah. I mean, it's even better for like everyone, not just participants, but I mean, if you're starting a business, don't you, liquidity is in venture capital markets, there's also a certain level of trust that goes into the liquidity that's out there. I mean, there's still people for some reason, there's these like bear mongering like Twitter feeds that are telling you that tomorrow we're going to go into a double depression kind of thing. If you have trust in markets and, markets are stable, those people are screaming into the ether. You know what I mean? But for some reason, there's always this mistrust of financial markets, and, really education and liquidity helps that. So yeah. I think liquidity is ultimately what the markets want. All right.
Yeah, I agree. All right, that was kind of fun, Mark. I like that. It's kind of like the viewer mail, getting.
We love viewer mail. More viewer mail.
More viewer mail. I mean, I have 3 more viewer mails, but we can't get to them today. We'll do it another time. All right. What's on tap for the weekend, you guys? Anything fun before we leave? Head out of here. Let's talk fun.
So I'm going to be gone. So this is good. It's good. Broadcasting. I'm going to be gone for the first 2-3 weeks in August. I'll be in Europe.
Really? Where are you going to Europe? I mean, what's
we're doing? We're doing a
Kinesis conference.
No conference. We're doing a cruise. We're flying into Madrid, then going to Barcelona, and then taking a cruise. We're hitting Cartagena and Gibraltar. But in the middle of the cruise is a total solar eclipse that we'll see while we're in the Mediterranean.
How cool is that? You didn't plan that?
Isn't that cool? No, yeah we did.
Yeah, you knew the solar eclipse was coming. I guess you could.
Yeah, you had to book it fast. You had to book it in advance. But then,
I love it.
Then we're finishing in Italy. What?
We're gonna get you on the show when you're in Gibraltar or whatever, and you give us the backdrop.
I'll have to look. I have to look at the itinerary. I'll tell you where I am.
Awesome. All right, good. Mark, what do you got going? You got your tennis garb on. I see.
Yep. Nothing anywhere near as exciting as a cruise around the Med. Having a pool party for my daughter's birthday, half birthday.
Oh.
Hey, I'm doing that on Thursday, next Thursday.
That's good. All right.
But it's a full birthday and a son.
Yeah, I can't even compete with either one of those. I'm enjoying the beautiful sun here in Chicago.
You're drinking wine.
Oh yeah, I don't drink as much anymore. Mark's got me beat here on this one, but I will have some. Maybe not tonight, but tomorrow definitely good wine. Really light weekend. A little golf, a little pool. Nothing big, just chilling.
Cool.
And thinking about my option strategies. Speaking of which, it's in. I have to give it CPR right now.
Yeah, I was gonna say I heard a little trading activity over there.
Yeah, I've got a patient that's almost KO'd here. I might have to go tend to him and give him some CPR.
So. I hope we're TPs, not SLs.
That's right.
I think some of those trading activities was mine because I put in limit orders for rolling, and they started all hitting during the show.
Oh, jeez. I heard ding ding.
Yeah, I didn't know you guys could hear that.
That's funny. All right, guys, have a great weekend. That's a wrap. We'll see you next week. Have a good fun time, Jason and Mark. What else?
Happy trading.
Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.